Hello, and welcome to the next in the narrated PowerPoint series for theme 4, Making Markets Work, and this is Chapter 16, Risk and Uncertainty. So it's a relatively short presentation, and it's really about trying to understand, number one, the difference between risk and uncertainty, and number two, some of the things that businesses and we can do to try to avoid risk and or uncertainty. Okay, so a little bit of a starter activity. How would you describe yourself? Do you think you're a risk taker or are you risk averse? What sort of things might affect you taking risks? What sort of things might influence you? And what sort of risks do you think, if you were an entrepreneur, you'd have to take when setting up a business? And finally, would you lend the person sat next to you £20, or do you think that would be a bit too risky? Are they a bit of a shady character and you're not going to see that £20 ever again, or will they pay it back with interest, as an example? So let's take a look at how we're going to go about this process then. So we're going to look at the difference between risk and uncertainty, and look at the impact of different types of shock on risk and uncertainty. Then we're going to look at a couple of ways in which we can try, as individuals or more likely businesses, to manage or manage risk, I suppose, manage risk or protect yourself from risk or uncertainty in a business context. So first things first then. There's some further reading on the difference between risk and uncertainty, and you can take a look at that by clicking on this link here, and this will take you to eventually, looks like I'm going to try and open it too. An article which describes a little bit more about risk and uncertainty, as you can see. Okay, so I'll leave you to take a look at that, and you can use that to help in your understanding of this particular example. Okay, so we're not going to move away from that Aston Martin before I start waxing lyrical about that beautiful car. So in this instance then we'll take a look at risk. So both risk and uncertainty deal with unknowns. It's an unknown thing that we're trying to deal with, and clearly if you don't know what is going to happen, that's clearly going to have an effect on your ability to make decisions about business futures. So let's take a look at risks first then. Okay, it's generally speaking, you can probably add a probability and somehow quantify a degree of risk to some degree. Okay, you can, if you're doing some sort of risk assessment, which I'm sure some of you have done in your jobs or have been a party to risk assessments, that to some degree you can sort of take a bit of a guess as to how risky something is. It's measurable to a point, and the difference between risks and uncertainties is that you've got no real quantifiable probability. If something's uncertain, it's by its very nature, it's an unpredictable event that you can't really decide on what the outcome is going to be. So to some degree, uncertainties are more difficult to deal with. It's not measurable, and in some cases, economic decision making will include both. There will be some risk and there'll be some uncertainty too, and particularly when you're thinking about forecasting or deciding on an investment strategy dependent on how markets might change. Well, clearly, and you couldn't have a better example of the times that we've faced over the last year or so in terms of uncertainties and risk in a lot of business decision making and economic decision making. Let's take a look at risk in a bit more detail then. Some examples of risks in business and economics include the following. So an entrepreneur setting up setting up a new business is clearly going to take risk because he or she is going to have to spend their own money, invest their own money, and they don't necessarily know what the outcome of that investment will be. They will do all they can to make sure it's a successful venture, but it's not something that they can absolutely 100% guarantee. They may have to give a paid employment, which obviously is a risk. They might have to invest their own personal savings into a venture, and that may not work. And clearly, if you fail in your attempts as an entrepreneur, there are issues around your personal esteem, and also the reputation of you as a business person. Okay, so clearly there are some risks that you are taking if you decide to, with some sort of entrepreneurial zeal, decide to open your own business. In some cases, dependent on the way in which you set up your business, you might actually end up with your family home and possessions being at risk too. If you were to lose money and lose more money than you'd originally invested, then you might have to get involved in selling some of your possessions to pay what you owe back to others. Okay. If we take as an example a financial institution when they're lending money, another example of risks in business and economics. Okay, will it get paid back? Is it secured against an asset? In some cases, some loans are. They tend to be mortgages, but they're not always. Okay, and that's where a bank will actually look for some sort of security against which it is lending. Okay, so if somebody then defaults, then they can sell that asset and get back the money that they've lent the organisation or the individual. What happens if the business fails? Again, it's something that in some cases, when financial institutions are thinking about lending to someone, they will try to take a bit of a view and look at the risk profile of the individual that they're lending money to. What's their credit history been like? Are they a reliable partner to lend to, for instance? Another example could be a supplier providing goods or services on credit. You supply it now, you supply the goods now, but actually you give the customer some time to pay. Well, that in itself is a risk. Okay, is the supplier going to get paid? If not, how much will they lose, and how serious is that loss going to be to their own business? So, if it's a big contract that you've received and you're giving the customer some time to pay, is that then potentially going to cause your business to fall over if you don't get paid? So those are some examples of risks. Let's look at the impacts of shocks next then. Okay, a shock basically is an unpredictable event that impacts on the economy in some shape or form. So generally speaking, if we talk about economic theory and think about all the things that we've talked about, some of the economic models, etc., no economic theory really is used or can be used to predict a shock. And obviously, you could argue that's one fundamental flaw. But to be honest, in some cases, some of these shocks are very difficult to forecast. Clearly, in a situation like this, a shock that's unpredictable is going to have a significant impact on all economic agents. So that's individuals, firms, and governments. And depending on what the shock is, clearly will depend on the effect that it will have on those different economic agents. So if we take a look at, to put some economic theory around this, okay, a supply side shock would be something that had a major impact on the provision of a good or service and will affect price. Okay, so to some degree, and it depends. Let's take as an example. Let's say our coffee growers have a very bad coffee harvest. Well, that's a supply side shock in that the good or service, in this case coffee, is going to, because of the poor harvest, is going to be in short supply, and that's clearly going to cause prices to increase. If we then take a look at a demand side shock, then let's just move me over here so you can see all of the content that you need to. Go back one. All right, that's clearly going to affect the consumption of a good or service, and again, that will also affect price. So if we have either a significant increase in economic growth and we get a significant increase in aggregate demand, then that will have an effect on the price of a good or service. As we've got more money to spend on disposal with more disposable income, that's going to mean that prices will go up. However, if demand falls for some reason, then that can have the opposite effect. Consumption will go down, aggregate demand will fall, and as a result of that, that will cause prices to fall too. Let's have a look at the impact of shocks in a bit more detail. And there's a few examples there that you can go and take a look at, which talks about sugar prices that have impacted on individuals in Tanzania, and also looks at the impact of changing food prices. So let's take a look at the impact of shocks then. Okay, so in some cases, this can affect the global economy. So a supply side shock, particularly in the form of food or commodities, that clearly can have a massive impact on the global economy. We think about between 2005 and 2008, prices of certain staple foods actually tripled. Now that's partly to do with the scenario that we faced in terms of the financial crisis, but also there's a number of other things that were going on. In fact, 2005, 2008, a bit earlier than the financial crisis, to be fair, that's probably more likely to be due to crop harvests not quite doing as they expected, or alternatively, significant amounts of demand, which has driven the price upwards. Obviously, in the second half of 2014, a range of global commodities prices fell significantly on global markets. And again, when that sort of thing happens, that does have an impact. That causes a shock wave through the whole of the system. If we think about some demand side shocks, then they often occur when there's negative news from a major economy. Now, clearly, 2008, the financial crisis and a range of negative factors led to a massive decrease in consumer spending in the US economy, but also across virtually every other developed country in terms of pretty much a global recession, with the exception maybe of China, who seem to benefit in some way from it. Obviously, there's another example that you could use, and you're probably aware of, that has been a massive demand side shock. So dwarfing the 2008 global crisis and financial crisis, and that obviously is the pandemic, where it's significant demand. It's not just a demand side shock; it's an absolute nightmare, isn't it, in terms of how demand for humongous numbers of businesses has pretty much fallen off a cliff because of the time that's been spent in lockdown and trying to fight the pandemic. It's quite interesting that if you then look at some of the issues that the government are trying to deal with in terms of budgets and the budget being announced today, an increase from 19% corporation tax to 25% corporation tax for any business making more than £250,000 worth of profit. So, to some degree, that's not really talking about an impact of shocks, but it's just demonstrating some of the things that are having to happen to deal with a significant demand side shock in this case. Okay, let's take a look at some options then that businesses may have to try to reduce risks caused by certain things. Okay, so in some cases, if we're actually trading internationally, there are all sorts of issues around trying to decide what price you're going to pay for a particular good or service, particularly if this then involves exchanging your currency for another one. And in some cases, what organizations can do is they can use what's called a forward market, where you set a price for an asset today for delivery in the future. Okay, so in essence, what they're designed to do, where you sell something forward or buy something forward, is to limit exchange rate risks. And this really occurs because obviously the exchange rate market is very dynamic and constantly changing, and obviously that can be very much affected by external shocks, both supply side and demand side shocks. So in this instance, what the business will do is it will complete a transaction today, but might decide that it's going to pay for that product at a later date. But the principle will be that you agree what the exchange rate will be at the outset of the contract, and then you agree that you will buy at that rate, even if the exchange rate changes during that time. Because clearly, if exchange rates change, that could adversely affect the profits that you achieve on a particular transaction. So firms will try and remove that risk by agreeing a fixed price at a future date when the transaction will be settled. Okay, so as an example, a firm might choose to import a ton of wheat from the US at an agreed price of $1,000 today. Okay. Now the exchange rate is currently, let's assume, £1 for $1, and that obviously would mean that at that rate, the actual contract, or the ton of wheat in this case, would cost you £1,000. So $1,000. We, for us to, in order to get $1,000, we'd have to exchange £1,000 at that exchange rate. Okay. Now let's assume that during that time frame, when this is actually paid for in dollars in say 3 months' time, let's say the exchange rate has moved negatively. Okay, and so effectively, or the pound has become stronger, if you like. So instead, we're exchanging a pound for is worth 80 cents. Sorry, so it's not actually got stronger; it's got weaker, isn't it? So in this instance, the firm would have to pay £1,250 for that same transaction. Okay, because the value of the pound has fallen against the dollar. Now, to negate that process, essentially, you agree this forward market price, and you sell forward or buy forward, and you agree that at the current exchange rate is what you will use when you have to pay for it in 3 months' time. So irrespective of what is almost like a forward contract, so you actually agree that you're going to pay at that level of exchange rate, and that clearly avoids the uncertainty and the change and the risk of exchange rates changing. Okay, so that's one way of doing it. Another way of doing it is to use insurance. Now, some of you will be familiar with insurance, and we may not have to have taken out insurance yet, and long may that continue, because it's a very expensive process, and you don't get a lot back for it. apart from, it does give you certainty, and it does tend to eliminate risk. Okay, there's a really nice, it's about 2 minutes long, about insurance at Cadbury, and it might be a job that some of you ladies might be interested in. So go and have a look at that. It's only a couple of minutes long. So in essence, what insurance is not dissimilar to this principle of a contract of selling stuff forward and buying stuff forward. But in this instance, it's a contract between two parties to look to provide financial protection against any losses incurred by a business. So what tends to happen, and this is the same in business insurance as it is in individual insurance, the price of insurance tends to increase dependent on the level of risk that's involved. So a high level of risk means the price of insurance becomes extortionately expensive. So what you do effectively is you pay a premium. So the premium that you pay is the price of the insurance. Okay, so let's say I decide that I'm going to insure my house and contents, and the premium for that for a year is, let's say, £200. So I pay that £200, and that means that during the time of the insurance period, so for 12 months, that if something happens to my house, let's say it's burnt down, that's a horrible thing to think about, but let's say it was, then the fact that I would have both buildings and contents insurance, my insurance, the insurance of my goods within the house would all be covered, but also the cost of rebuilding the house would also be covered. Okay, so that's the premium that you pay. Insurance companies tend to take a view on things, and they will use actuarial activities to assess the risk, and then decide on how many people are likely to claim on that particular insurance policy, and then try to arrive at a price. Now, the payout in that instance is the cost of the insurance, should they have to honour that contract. Now, in most instances, most insurance, I can't think of the last time I claimed on my insurance, but thinking about the amount of money that I pay out in insurance for various personal insurance, that clearly is designed so that it takes away the risk of certain things, external shocks happening. So in some cases, insurance can protect a business from severe losses, but it also provides confidence to invest time and money into the business as well. Because if you've got business continuity insurance or public liability insurance, that's designed to protect the business from various different risks that could do them some harm. loads of different types of policy, liability insurance in case your business has caused an injury to somebody or has damaged some property. So insurance is clearly a good way of avoiding or accounting for risk that you might be taking. Okay, so that's basically just covering a little bit on risk and uncertainty, and we've covered the difference between risk and uncertainty, the impact of shocks, and some examples of how businesses might choose to use either exchange rate risks and forward markets to protect themselves from that particular risk. And in addition to that, we also looked at the role of insurance in business. So, relatively short one, that ladies, but that hopefully makes some sense, and we'll talk very soon. Thank you for listening.